Hi, folks. Welcome. This is today's webinar from Bob Benny Wealth Management. Actually, we're going to stop calling them webinars, Jesse. We're going to start calling them Bobcasts. Isn't that catchy? She's not as thrilled about my new name for the Bobcast as I am. But anyway, welcome to the webinar today from Bob Benny Wealth Management. I'm Bob Benny.
I'm Jesse Thompson.
And we're with Bob Benny Wealth Management. And our topic today is mastering the mind game, navigating the psychology of smart investing. And one of probably the most famous investor in the world is Warren Buffett. And here's Warren's just from Omaha, 50 miles from here. He said, if you cannot control your emotions, you cannot control your money. And it's so true. We've seen from our experience, decades of watching investors and prospects, and if you can't control your emotions, you're going to have problems. And so the mind, this topic today is about how the mind plays a huge role in your investment success.
If you have any questions while we're going through anything today, you can type those in at the bottom of your screen and we will go through those at the end of the webinar.
Yep.
So we're going to jump right into it and talk about kind of what are psychological biases. And this is something that I've been studying personally because I'm working on my CFP right now. I take my test in about a month. And something that they go over pretty in depth in the CFP education is psychological biases that all investors are prone to. And basically, these are like subconscious thinking patterns that everyone has that you might not even realize that you have that affect your ability to make rational investment decisions. And so we're going to kind of go through, there's a whole bunch of them, and we're going to kind of briefly go through each one. And I just want to encourage you to think about if you relate to any of these thinking patterns, because that's part of overcoming these different psychological biases is knowing which ones apply to you and kind of being self-aware that way. So let's go ahead and get started. There's two types of psychological biases, and there's cognitive biases and emotional biases. And cognitive biases are basically like you are just used to thinking about something a certain way, and you're so used to it, you don't even realize necessarily that you're wrong. And those kind of biases can be overcome if you have the right information, basically, and the right kind of education for those. And then there's emotional biases, and those are things that your heart's more tied up in those things. And so those are a little bit harder to overcome, and you might need a little bit of help from a financial advisor, things like that to help overcome those biases. So we're going to jump in and start with the cognitive biases. And there's a whole bunch of different biases that I've tied up all in one thing called stubbornness biases.
Some of us have a problem with stubbornness.
Yes. And so basically this is clinging really hard to an opinion or thought process on something, whether that's investing, whether it's a particular stock or company, clinging to an opinion about that thing that's either outdated or irrational, even when new information is available. And so some examples of this would be like, you only read articles or only look for information that already supports what you already think. People do that. Everybody does that. We do that all the time.
That's called confirmation bias.
Another one is failing to change your viewpoint even when newer or better information becomes available that proves what your viewpoint is incorrect. Another thing is believing that the past will persist, whether that's past performance of a certain investment or the market. Another thing is taking action based on the outcome of prior events. So maybe prior market events, or again, relying on past performance. Maybe thinking that, oh, a certain crash happened in history, and so I'm going to invest my assets now in order to avoid what happened in that crash, kind of things like that. And then another example is anchoring yourself to an initial like price or value of something, whether that's an investment, or a good example of that is like gas prices. So whenever gas prices got really expensive, was that in 2021?
Right.
Gas prices went way, way, way up. And now they're down a little bit from then, right? So when we think back, when we compare now to then in 2021, we might think, oh, good, gas prices went down so much and they're so cheap right now. But then if you compare what gas prices are like now to what they were like a little bit further back in time, what, 4, 5 years?
Yeah, 2020.
Something like that.
They're way low.
You would say they're they're actually more expensive still. So it's just kind of a viewpoint thing and kind of sticking something in your mind that you need to update your thought process on.
Right.
And
So
the opposite of this is a different bias called recency bias. And that's throwing out all old information or all historical information and only relying on the most recent information that you got because that's the newest information that's in your head. And that's called recency bias. And that's also that also can help cause you make bad decisions.
So some more moving along, some more cognitive biases, but one would be control bias. And that's thinking that you can control account performance and should be able to know what the market's going to do. Looking at hindsight or illusion of control, those kind of things. It goes along with the another bias called overconfidence bias that we're going to talk a little bit later. And then there's another bias called herding bias. That's just following the crowd, following the herd. You start hearing that everybody's buying this or selling this, and you just go along with it. It's because you have a fear of missing out. Well, more often than not, when you follow the herd, you might just follow the herd off the cliff because it's causes you to buy at the wrong time and to sell at the wrong time. And then there's a bias that's called mental accounting bias. And it's kind of like people having a perception that they have different buckets of money or jars of money for their house, for their car, for travel, education, that sort of thing. In reality, all of their money is actually in one pot, but that's a bias where people can get mixed up on what they're doing. Then we have emotional.
Yeah, now we're gonna move into the emotional biases. And like we talked about before, these ones are a little bit more difficult to people because they have feelings tied up in their thought processes about these things. And one of the biggest ones that we see is loss aversion. And that's when people prioritize preserving principal or just avoiding losing money over earning gains, and it hurts them in the long run. So there's been studies that have shown that actually the pain of a financial loss sticks in people's heads much more strongly than the reward, I guess, of experiencing a gain.
An example of this too would be someone that's so afraid of losing money, quote unquote, on paper, that they just say bury all their money in a can, in a coffee can in the backyard, so they know they're not going to lose their money. Well, but they're not earning anything on their money, and they're losing buying power with that money, even in a normal interest rate environment. In today's interest rate environment, the biggest financial threat, we've talked about on these podcasts before, the biggest financial threat to all Americans and everybody in the country, or I mean in the world, is this super high inflation that we've started to experience and is just going to get worse because the government printed so much money. And so, you know, if you have your money, let's say somewhere quote unquote safe, like the bank, so you can't lose principal, you still are losing buying power with it. Because if inflation is 10 or 15% and you're making 5%, you're going in the hole every year that happens and losing buying power. So the loss aversion bias causes people a lot of problems, especially when people have been kind of fearful over the last 3 or 4 years. We notice a lot of people have been hoarding money.
And so, I mean, there is times in certain specific situations, of course, where people need to protect their principal. Like if you're saving up for a specific purchase and you've had some money that you're saving up for a down payment on a home, or for things like that that are near-term things
Right.
where you can't afford to lose anything. Of course, there's situations where you need to invest to protect your principal, but with this loss aversion bias, it's people, because they're fearful, invest too conservatively to meet their goals. Whether that's, a lot of times that's retirement or retirement income. It also causes people to sell when they should be buying and sell when they should be buying and buy when they should be selling. So they might have like an asset that is going in the hole and it's just fundamentally not a good asset anymore, but they don't want to sell it and take a loss on it. Just because they don't want to lock in that loss. And so they'll hold on to it when it's no good anymore and they should
have got out
of
of it
it
before, right?
Mhm.
So,
The next emotional bias that we have is overconfidence bias. And this kind of goes with that control bias that's a cognitive bias, but it also has like, it's emotional because it has ego involved in it. And it's thinking that you can control investment outcomes if you know enough. If you're smart enough, you can
beat the market,
or you can, not have your account go down when everything else go down, things like that. And it's kind of also, you are responsible for gains, but something or someone else, AKA like the economy or the stock market, is responsible when you experience a loss. So you take credit for gains, but you
blame
are a
something else
victim
for
when
the
it
losses.
comes to when it comes to losses, and it's all tied up into ego, and that's why it's an emotional bias.
So another one is staying stuck biases. So that's being so comfortable, being too comfortable to make changes, or being too scared to make a mistake. You're just kind of frozen with fear, or just don't want to make the changes that you should make.
And this is something that can cause people to, I think people can get comfortable maybe in portfolios that are maybe a little bit too conservative for what their goals are, just because they're like, well, I'm not losing, so it's okay, when really they're not experiencing the same amount of gains that they really need to be probably experiencing for the goals that they have. Which
again is so important now, because the biggest financial threat to everybody watching this webinar, and frankly everybody in the world, is this super high inflation that we're facing, that's going to keep going on for a while. So we need to invest our money in asset categories or classes that protect against inflation.
Okay, and then the final biases, I've wrapped these up into one. They're a little bit different, but it's endowment bias and affinity bias.
Affinity bias. You said it right this time.
Yeah, I kept saying infinity earlier.
In the practice, yeah, but it's affinity.
And basically, endowment bias means that because you already own something or you bought something, you consider it more valuable than it really is. So basically, you're giving it undue loyalty just because you already own it. And Dad has a really good story example of that.
Oh, yeah. I just realized we've got the French fry slide up there, and that's to remind me of the French fries. So long time ago, 20 years ago, I had an office in Omaha that I worked at part-time from Bob Benny Wealth Management in Omaha. And I had this guy come in that had retired a few years prior with $500,000 in his 401k. He rolled it over into his own self-directed IRA and then started buying stocks with it. The account that was $500,000 at retirement 3 years later, when he came to see me, was only $80,000. He ran it from 500,000 to 80,000 in 3 years. And I looked at he showed me the statement. I looked at the stocks, and I remember I kind of did it like this, went kind of like a humph. These are all penny stocks. And the guy's response, I'll never forget, was, well, they weren't penny stocks when I bought them. A penny stock, by the way, for those of you that don't know, is a stock whose stock price is less than $5. And he said, well, they weren't penny stocks when I bought them. Well, one of these stocks was called Tasty Fries. I mean, I go, what the heck is Tasty Fries? And he said, well, it's a company that produces and sells vending machines that sell French fries. That doesn't even sound like a good idea to me now, but obviously it wasn't a good idea because they weren't able to sell very many of those vending machines, and the price of the stock went really down, and that was a significant part of his loss in going from 500,000 to 80,000 in the whole account. But you know, he was just stuck on that Tasty Fries. He just thought, oh, this is a good idea. And then as it went down, he thought, well, maybe it'll come back up. And then as it went down, he was just stuck, and he couldn't get out of it, or wouldn't get out of it.
That's a great example of this endowment bias that we're using it for, but it also, there's other biases. It's an example of other biases that we've talked about too. So it's an example of that loss aversion bias where it's going down, but man, I don't want to take a lot of those stocks. Man, I don't want to take a loss on these
things. I lost.
It's an example of the overconfidence bias because he thought, well, I can do this, you know, I can do this myself. I know how to pick these. These are all going to be just ringers, type of thing.
They were ringers, all right.
When they weren't. So it's a good example. And then affinity bias means basically you're overvaluing, you're giving more value to a particular investment or company if it's a stock, just because it's something that you like or it's like familiar to you, when maybe intrinsically it's really not that valuable and you're holding onto it.
Like maybe this guy really liked French fries and liked the idea of just putting a quarter or whatever you do and getting some fries.
Yeah.
But they wouldn't have been as good as McDonald's fries. Anyway, then now we want to talk to you about the impact of these psychological biases on investment performance, and particularly how having these any of these different kinds of investor biases, emotional or cognitive biases, can give you suboptimal performance in your investments. And Jesse's got some case study, or a case study to show you.
Well, there's this company called Dalbar, and basically they do studies every year, and they have for a super long time. Like this one has been going on for 30 years, where they compare the average investor who's investing their own portfolio for themselves. They compare their performance every year with the performance of the S&P 500 index, the 500 largest companies on the New York Stock Exchange. And they just compare and see, you know, how the average person investing their own money does just in comparison to this index of companies. And consistently, on a consistent basis, the average investor loses just compared to the index. And a big reason for that, the main reason for that, is because of all these different investor biases that cause people to buy and sell and make investment decisions at the wrong time and for the wrong reasons.
Right.
And so as you can see on this chart, the average equity fund investor over the last 30-year period, this is ending in 2022. I didn't find a chart that ended in 2023, but the situation is the same. The S&P 500 greatly beat the average equity fund investor in 2023. But the average investor did about 6.81% over that 30-year period.
Per year.
Per year. In the S&P 500 did about 9.65%. It's almost a 3% difference. And you think that's really not that big of a deal. It's only 3%.
It's a big difference.
Over a long period of time, if you look there on the bottom, that's almost twice as much money the S&P 500 made in comparison to the average investor. That's
showing that the average investor doing it on their own over that 30-year period, $100,000 would grow to $721,000. That seems nice. But they could have had double that if they weren't investing on their own and had just stuck it in the S&P 500 and just left it alone.
Index fund. Yeah. Right. So let's talk about now some strategies that you can use and we can use to mitigate these psychological biases. So the first one is just having self-awareness and educating yourself on what these are, and thinking about, like I hope that you were over these last few minutes, about, you know, what am I most apt towards? What bias am I most apt towards in my thinking process, or with my feelings that might cause me to make mistakes? Like,
Like maybe somebody that, you know, they watch TV or listen on the radio or internet or whatever, and some news stories cause them to fear and panic and want to sell something that they maybe probably shouldn't be selling. So-
And when you have the self-awareness to realize kind of what's going on, when you feel that way or feel the urge to make an investment decision based on some way you're feeling or
Yeah.
something like that, it gives you kind of more power over that decision.
Yeah. And so, you know, a strategy, one of the best strategies is to have a plan, implement a disciplined investment strategy, come up with a plan and stick with it. You know, plan for volatility in your investment ahead of time and invest accordingly, according to your own risk tolerance and your tolerance for how much it can go up or go down. Invest for the long term. You know, if you're a retiree or a near retiree and you're whatever 65 years old, just because you're retiring now doesn't mean that you're done, that your money is short-term money. Your life expectancy at age 65 is probably another near 20 years. And then that money's maybe going to go to your family. So it's long-term money. Stay diversified. That's another strategy, is to be diversified. There's also strategies where if you're really uncomfortable with market fluctuation, there are different investment products you can buy or invest in that have insurance features that protect you for income or protect your family for a death benefit. And they charge a little bit for the insurance in there, 1 or 2%, depending on what you get. But that's a way of having a strategy to keep yourself from making the wrong decision at the wrong time. Plan for when you're going to make potential changes ahead of time. Like if this macroeconomic thing happens, if this big macroeconomic thing happens, I'm going to do this. For instance, an example of that is right now, because of all this high inflation, we've seen interest rates going up. And they're kind of in a pause right now. And the pause, we think, is because it's an election year. But after that election gets over with, I'm very confident that the Fed is going to keep raising interest rates. They have to, because that's the only tool they can use to head off inflation. So here, my point about microeconomic situations, when interest rates get up real high, like maybe they did in the early 80s, late 70s and early 80s is when this happened before. And if interest rates get up to, let's say, 12% on a 30-year treasury, we're going to advise our clients to move some of their money out of companies and into 30-year treasuries, paying 12%. You say, well, why would I want something for 30 years if I'm whatever, 70, 80 years old? Well, that's not how it works. You can sell the 30-year treasury any business day. But remember this thing with this teeter-totter of interest rates over here and market values of bonds over here. When those treasuries are at 12% and you buy them, pretty soon interest rates are going to go down. When the interest rates go down, you know, through the years, you're going to get 12% on your treasury investment. But when the interest rates go down, say 5 years down the road, to more normal levels, you're going to be able to sell the treasury at a big gain, maybe 20% plus gain. So that's what I mean by having a plan ahead of time, like the plan that we have for the clients' accounts that we manage, having a plan ahead of time for certain macroeconomic conditions.
Yeah, and there's really two situations that you need to have a plan ahead of time for. That's if the macroeconomic situation changes and if some big circumstance in your life changes.
Right.
Those are the only two. It's not if something changes in the market, because we don't make investment decisions based on these short-term market movements or what the market's doing. If you make a decision based on what the market is doing, you are already too late. So
That's right.
that's why it's really important to have a plan ahead of time and stick to knowing when you're going to make a move.
The final point of strategy, of having a strategy, is to watch where you get your advice. some of the worst places to get advice is coffee shop talk. Because although the people you're drinking coffee with, your old buddies, are great to drink coffee with and tell stories about the good old days and all that stuff, that's not the best place to get financial advice. A lot of times people fib to each other about how well they've done on their investments. Don't follow the coffee shop talk. Those guys aren't experts at investments. They might be experts at talking and drinking coffee, but they're not, and they might be great friends, but they're not experts at investments. Don't pay any attention to the news media. The news media is selling news. They're not financial advisors, even if they're on a financial news channel or they put themselves out to be a financial person. They're not. They're selling, what they're selling is your attention to get you to keep watching or listening through the commercials. We recommend to people to seek professional advice from competent and trustworthy financial advisors, and see if there's a fit between the financial advisor and you and the way you think. And that's what we do for our prospective clients and for our clients. So a good financial advisor can help educate you out of cognitive biases and encourage you to overcome those emotional biases.
Yeah, it's about much more than just helping you invest your money. It's about helping guide you to not make investment mistakes
Yeah.
as well. In addition to, I mean, we help with tax planning, estate planning,
Retirement income planning, all kinds of, anything to do with money, we help our clients with. And we'd love to help you. And do we have any questions? Hillary? No, we don't have any questions. So just want to encourage you to contact us by email or by phone if you have any questions about this webinar or anything else financial. Please let us know if you have any friends or family that we can be of help to, because that's what God put us here to do, is to try to love and help people. So anyway, thank you very much and
Thank you.
have a blessed day.